Okay, so you think insurance is a company that takes your money and pays for your accidents. The logic is clean. You send a payment every month. Somewhere in a building full of desks, that payment sits in a pile with everybody else's payments, waiting. When your car gets hit at an intersection, someone opens the pile, counts out what the repair costs, and sends it to the body shop. The company keeps the difference between what everyone paid in and what the unlucky ones took out. Collect a lot, pay out a little, keep the gap. That is the whole machine. That's the story. It is also, financially, backwards. Here are the numbers that make it collapse. The American property and casualty industry collects somewhere around $900 billion in premium every year, and in a typical year, it pays out and spends essentially all of it. Not most of it, all of it. The industry's combined ratio, every dollar of claims and every dollar of overhead, divided by every dollar of premium, hovers right around 100%, and in bad years, it goes above. Meanwhile, in 1967, Warren Buffett paid $8.6 million for a small Omaha insurer called National Indemnity that was holding about $19 million in premiums it had not yet paid out. That single idea, compounded for 6 decades, now holds more than $160 billion. And United Health Group moves roughly $400 billion through its books in a year and keeps a net margin in the low single digits. An industry that keeps almost nothing on the thing it sells, built into one of the most durable money machines in the history of capital. Here is the resolution. Insurance is not in the business of covering losses. It is in the business of holding money. The premium is not a purchase. It is a loan, made by the customer, at an interest rate of 0, with no fixed repayment date and no guarantee it will ever be repaid at all. The claim is just how the loan sometimes comes due. Everything you think is the product is actually the mechanism for acquiring the loan. By the end of this video, you will understand why the most profitable insurers in the world are indifferent to whether the policy itself makes money, and why the entire industry lives or dies on a number almost nobody outside of it has ever heard of. Start with where this came from, because the origin explains the whole shape of it. In the 1680s, London had a capital problem it could not solve. A merchant could load a ship in the Thames, send it to the West Indies, and either double his money or lose everything, and there was no middle outcome. One storm, one privateer, one rotten hull, and a family's entire fortune was at the bottom of the Atlantic. The consequence was not that people took the risk anyway. The consequence was that voyages that should have happened did not happen. Capital sat still. The risk was not merely painful, it was so concentrated that it made rational men refuse to move. The solution appeared in a coffee house. Edward Lloyd ran a shop near the Thames where shipping men gathered because he had the best information. Arrival times, cargo manifests, wreck reports. Merchants started using the room to do something new. A ship owner would write the details of a voyage at the top of a sheet of paper and pass it around, and men with money would sign their names at the bottom, each one taking a stated fraction of the risk in exchange for a stated fraction of a fee. They wrote their names under the terms. That is where the word underwriter comes from, and it is a literal description of a physical act. Notice what actually got invented there. Nobody made the ocean safer. Nobody reinforced a single hull. The storm risk was exactly what it had been the week before. What changed was that a loss which would destroy one man was chopped into 40 pieces that would merely annoy 40 men. The danger was not reduced, it was divided. Then came the second invention, which is the one that turned a gambling room into an industry. In 1693, the astronomer Edmund Halley, the Comet Man, took the birth and death records of the city of Breslau and built one of the first real mortality tables. He could not tell you when any specific person in that city would die. That was and remains unknowable. But he could tell you, with startling accuracy, how many of 10,000 30-year-olds would be alive at 40. The individual was random. The crowd was not. Benjamin Franklin took that logic to Philadelphia in 1752 with the Philadelphia Contribution Ship, which insured houses against fire and bolted a metal fire mark to the front of every covered building. Franklin's group also refused to cover houses with wooden additions and pushed the city on hazards, which is the moment the industry discovered it could change the odds it was betting on rather than only measuring them. So the founding insight was never about protection. It was that a risk which is unknowable one house at a time becomes a calculable, boringly stable number 10,000 houses at a time. Insurers do not sell certainty to the individual. They buy uncertainty from thousands of individuals and convert it, by aggregation, into a predictable expense line. They were not selling safety. They were selling arithmetic. Now take a single unit and follow it all the way through, because this is where the abstraction becomes visible. The unit is one auto policy for 1 year. Call the premium $2,000, which is in the neighborhood of what full coverage costs an ordinary American driver. That $2,000 arrives, usually in monthly slices, and the customer's understanding of the transaction is that it buys 12 months of protection. Here is what actually happens to it. Take 100 of those policies, $200,000 collected in a year. Over those 12 months, roughly 6 of those 100 drivers will file a claim that costs real money. Most are small, a bumper, a mirror, a windshield. A few are not. A rear-end collision with a neck injury, a totaled vehicle, a liability claim where the other driver has a lawyer. Blend the fender benders with the serious ones, and the average paid claim lands somewhere around $23,000 once medical bills and legal costs are counted. 6 claims at $23,000 is $138,000. That is $1,380 out of the $2,000 policy, 69 cents of every premium dollar gone to the thing the customer thinks they bought. The customer's mental model stops there and concludes the company kept $620. It did not. Paying a claim is itself expensive. Someone has to inspect the car, photograph the damage, argue with the body shop about aftermarket parts, take statements, review medical records, and in a meaningful number of cases, hire a lawyer. That is a separate line in insurance accounting, loss adjustment expense. And on auto, it runs around 12% of premium, another $240 off the policy. Then acquisition. Somebody sold this policy. An independent agent takes a commission, typically in the range of 10 to 15% of premium on personal auto, and a direct writer that has no agents instead spends the same money on television, search ads, and a name people recognize at 2 in the morning. Either way, it is real cash, and it is spent before a single claim is filed. Call it $220. Then the company itself. Underwriters, actuaries, claim systems, regulatory filings in 50 states, reinsurance costs, the building, around 9%. Another $180. Add it up. $1,380 plus $240 plus $220 plus $180 equals $2,020. Against $2,000 collected, the combined ratio is 101. The company lost $20 selling that policy. This is not a failing insurer. This is a completely normal year in personal auto, and it is the number the entire industry orbits. Read it clearly. The product, priced correctly, sold competently, to a customer who is happy, generates a loss. So follow the calendar instead of the ledger. The $2,000 arrives across the year. The claims do not leave at the same speed. A windshield gets paid in a week. A collision repair takes a month. A bodily injury claim with an attorney, a course of physical therapy, and a negotiated settlement takes 18 months and sometimes 4 years. Averaged across the book, the company holds that money for something like a year and a half before it goes out the door. Which means at any given moment, against that one policy, the company is sitting on roughly $1,500 of somebody else's money. Invested at 4.5% in short-duration bonds. Not aggressive, not clever, the most boring portfolio a regulator will approve, and it produces about $100 a year. Underwriting, minus $20. Investment income, plus $100. Profit on the policy, $80. More than the entire profit came from holding the money. None of it came from selling the product. The policy loses money. The calendar makes it. Now add a second effect, because one policy understates this badly. That $1,500 of held money does not go away when the policy expires. In January, the driver renews, and a new $2,000 starts arriving while the previous year's unsettled claims are still working their way through adjusters and attorneys. The old money leaves in pieces, at the same time the new money arrives in pieces, and the pile stays roughly level. Scale that to a real company. An insurer with 10 million auto policies in force is not holding $1,500. It is holding something on the order of $15 billion. And that $15 billion does not have a maturity date, because it is not one loan. It is 10 million overlapping loans in permanent rotation, each individually short and collectively endless. This is the difference between a debt and a balance. Any individual policyholder is repaid or is not, within a couple of years, and the matter closes. But in aggregate, the sum never comes due, because the only way to be forced to return all of it at once is to stop selling insurance entirely. A growing insurer's float grows. A flat insurer's float sits there. Only a shrinking one has to hand the money back, and slowly. 10 million small promises add up to one permanent loan. Now look at how that shows up when you open an insurer's actual financials, because it explains a reporting habit that confuses everyone who reads one for the first time. An insurance company reports revenue in two fundamentally different lines that behave nothing alike, and the difference between them is the whole business. The first is earned premium. This is the money customers pay, and it comes with a matching obligation attached. Every dollar of it carries a future claim that has not happened yet. It is revenue in the accounting sense and a liability in the economic sense. When Progressive books around $75 billion of revenue, the overwhelming majority of that is premium, and the overwhelming majority of that premium is spoken for. On this line, the good insurers keep 4 to 6 cents on the dollar, and the average one keeps roughly 0. The second is net investment income. This is what the held money earns while it waits. It carries no claim obligation, no loss adjustment expense, no commission. It is the cleanest revenue in financial services, and it drops almost intact to the bottom line. The split by sector tells you where the leverage lives. Property and casualty, auto, home, commercial, is the classic float business, because claims are messy and slow and the money sits. Life insurance and annuities are the extreme version, and the arithmetic there is almost comic. Take a 35-year-old buying a whole life policy at $3,000 a year. The insurer's actuaries expect to pay the death benefit somewhere around age 80. That is 45 years of collecting money against a single payment made in the middle of the century. Even at a modest 4%, the first year's $3,000 compounds to roughly $17,000 by the time the claim arrives, and every subsequent year's premium is running its own compounding clock behind it. The mortality tables barely matter. Haley solved that part in 1693, and the industry has had 3 centuries to refine it. A life insurer is functionally an asset manager wearing a policy as a costume, and its earnings track its investment portfolio far more than its death experience. That is also why life insurers are among the largest holders of corporate bonds and commercial real estate on Earth. They have the longest calendar in finance, so they can own the least liquid things in it. Health insurance is the instructive opposite. United Health moves roughly $400 billion a year, which makes it one of the largest companies on Earth by revenue, and it keeps a net margin in the low to mid-single digits. The reason is structural, and it is written into federal law. The Affordable Care Act's medical loss ratio rule requires health insurers to spend at least 80% of premium on actual medical care in the individual and small group markets, and 85% in the large group market, or refund the difference to customers. That regulation directly caps the gap. And the other half of the problem is speed. A doctor's bill is submitted in weeks and paid in weeks. There is almost no calendar. Health insurers hold enormous revenue and very little time, and their returns show it. That is the tell. 2 insurers of similar size can have completely different economics based on nothing but how long the money sits still. Premium is the volume. The waiting is the income. Before going further, look hard at the largest cost line because it is stranger than it looks. Losses and loss adjustment expense, claims plus the cost of handling claims, consume roughly 70 to 80 cents of every premium dollar. It is by an enormous distance the biggest number in the business, and here's what makes it unlike any other cost line in any other industry. The company does not know what it is. A car manufacturer knows the steel bill, a restaurant knows the food cost. An insurer that sold a policy last March genuinely does not know what that policy cost. Some of the claims have not been reported yet. Some have been reported but not settled. Some are settled but being appealed. So the company writes down a number that is, formally, an estimate, the loss reserve. Actuaries build it from historical patterns, and there is a line item on every insurer's balance sheet with an acronym that ought to be more famous than it is. IBNR, incurred but not reported. Losses that have already happened, that the company already owes, that nobody has told it about yet. Sit with that. The single largest expense on the income statement is a forecast of an event that has occurred but has not yet been described. This is why insurers report something called reserve development, and why analysts care about it more than about the current quarter. If a company set aside $500 million for a year of claims, and those claims eventually settle for $450 million, it releases $50 million into earnings, profit created by having been wrong in a pleasant direction. If they settle for $600 million, it takes a charge and the earnings vanish. Long-tail lines like commercial liability and medical malpractice can develop for a decade. It is entirely possible for an insurer to report 5 consecutive profitable years and then discover that all 5 were losses. And this uncertainty is precisely why the money must sit in reserve rather than be paid out to shareholders. The reserve is the float. The two are the same pile of cash seen from opposite ends, a liability to the actuary, an asset to the investment officer. The industry's biggest cost and its greatest advantage are literally the same dollars. They sell a product whose cost is an educated guess and get to invest the guess. Now the mechanism, stated plainly. Float is the money an insurer holds that belongs, eventually, to somebody else. Premiums collected minus claims paid out, accumulated. It is not equity, it is not borrowed in any conventional sense, and it never appears as profit. It is a balance that persists as long as the company keeps writing policies, because as old claims are paid, new premiums arrive to replace them. Individual dollars leave constantly. The pile does not. Compare it to the business model everyone already understands. A bank takes deposits and lends them out. That is the same structural trick. Hold other people's money, earn a return on it. But a bank pays for the privilege. It offers interest, ATMs, branches, an app, and it competes on rate. Deposits have a cost, and when rates rise, that cost rises with them. An insurer with a combined ratio under 100 is doing something a bank cannot. It is being paid to accept the deposits. If a company collects $2,000 in premium and ultimately pays out $1,950 in claims and expenses, it held that money for a year and a half and was handed $50 for the trouble. The cost of those funds is not 2% or 4%, it is negative. This is the entire Berkshire Hathaway insurance thesis, and Buffett has never been coy about it. National Indemnity in 1967, $8.6 million, carrying $19 million of float. Geico, General Re. National Indemnity's willingness to write enormous, weird, catastrophe-exposed policies that other people would not touch, because those policies pay slowly and therefore generate the most float per dollar of premium. That $19 million became more than $160 billion of money held. Money that has been compounding for 58 years in equities and whole businesses at returns far above what a bond portfolio would produce, funded by policyholders who received exactly what they were promised and are owed nothing more. No one was cheated. The claims were paid. The genius was never in the claims. Understand what this does to the definition of a good insurance company. A conventional business grows by making its product more profitable. An insurer can grow by making its product barely profitable because every additional policy sold is an additional deposit acquired at a cost of roughly zero, and the deposit is the asset. Underwriting is not the profit center. Underwriting is the customer acquisition cost for capital. A bank pays for its deposits. This one gets paid to take them. Here is where the model gets counterintuitive, because it inverts the usual relationship between doing your job well and making money. Put two insurers side by side. Both write $1 billion of premium a year. Company A writes personal auto. It is disciplined and technically excellent, running a combined ratio of 96, a $40 million underwriting profit on the billion. But auto claims settle fast, in well under a year, so its float is modest, perhaps $700 million. At 4%, that is $28 million of investment income. Total, about $68 million. Company B writes commercial liability. It is mediocre, running a combined ratio of 103, a $30 million underwriting loss. It is worse at the job by every measure a customer would care about. But liability claims take 4 or 5 years to settle, so against that same billion of premium, it holds float of roughly $3 billion. At the same 4%, that is $120 million. Total, about $90 million. The worse underwriter earns 30% more, not because it is cleverer, but because its customers' money stays in the building longer, which produces the second inversion, the one that makes insurance genuinely dangerous. In almost every industry, aggressive growth costs money in the short run and pays off later. In insurance, it is the reverse. Writing a lot of new business immediately depresses reported earnings. Commissions and reserves are booked up front, while premium is earned over time, while immediately increasing float. So an insurance executive can grow the balance sheet, drive down the reported margin, and be right. Or do exactly the same thing and be catastrophically wrong. The two look identical for years. That gap is where insurers die. Not from a hurricane. From a decade of writing underpriced policies to gather float, funding today's claims with tomorrow's premium, and discovering that the reserves set aside in year 3 were half of what year 8 actually demanded. The industry has a name for the pattern of everyone doing this at once and then abruptly stopping: the underwriting cycle. Rates soften while capital chases float, losses eventually surface, capital flees, rates spike, discipline returns, and the whole thing rotates again roughly every decade. Bad underwriting can beat good underwriting, right up until it does not. So who actually collects the money in this system? Follow it out of the customer's account and watch where it stops. Layer 1, the reinsurers. An insurer that has written 100,000 homeowners policies in Florida does not carry that exposure alone. It buys insurance on its own book from Munich Re, Swiss Re, Hanover Re, or the syndicates at Lloyd's. A meaningful slice of the premium goes straight back out the door to them. And reinsurers run the float model at its purest. They hold enormous sums against events that mostly do not happen. They are diversified across every continent and peril, and they are almost invisible to the public. Nobody has a reinsurance company's jingle stuck in their head. Layer 2, and this is the one worth staring at, the brokers. Commercial insurance is almost entirely sold through intermediaries: Marsh McLennan, Aon, Arthur J. Gallagher. They place the risk, take a commission on the premium, and collect additional fees for advisory work. Their operating margins run in the mid to high 20s as a percentage of revenue, several times what the underwriters they place business with earn on premium. Run one commercial program through, and the split becomes obvious. A mid-sized manufacturer buys a $10 million property and liability tower. The broker structures it, takes it to market, and collects a commission in the neighborhood of 10%. Call it $1 million, booked the moment the policy binds, against maybe 2 months of a team's time. The carriers underneath split the remaining $9 million, hold it for years, pay out perhaps $6.5 million in claims and $2.2 million in expenses, and keep $300,000 in underwriting profit, plus whatever the float earned along the way. The broker made 3 times what the risk takers made, on the same policy in 1/20th of the time. And here is the part that should reframe the whole industry. The broker takes no risk. None. When the hurricane lands, the broker does not pay. Their revenue scales with the size of the premium, which means it scales with catastrophe. Hard markets raise rates, and the commission is a percentage. The people with the highest margins in insurance are the ones who never insure anything. Layer 3. Increasingly, the capital markets. When catastrophe exposure exceeds what reinsurers want to hold, it gets packaged into catastrophe bonds and sold to pension funds and hedge funds. The investor collects a high coupon and loses principal if a named storm of a defined severity hits a defined area. The market is now tens of billions of dollars. A pension fund in Europe holds part of the wind risk on a roof in Tampa, and neither party will ever know the other exists. The broker never once touches the risk. Now the threats. Because a business built on holding money has failure modes specific to holding money. The first is reserve inadequacy driven by social inflation. This is the quiet one, and it is the most lethal. Claims settle years after policies are priced, and the cost of settling has been rising faster than general inflation, larger jury awards, litigation funded by outside investors, aggressive plaintiff advertising. Commercial auto and general liability have been hit hardest. A policy priced in 2019 against 2019's expectations gets settled in 2026 against a verdict environment nobody modeled. The company does not find out it mispriced until the money is already gone. The second is correlated catastrophe, which attacks the founding mathematics directly. The entire industry rests on independence, the assumption that your house burning down has nothing to do with your neighbors. A hurricane annihilates that assumption. Every policy in a region fails on the same afternoon. Hurricane Katrina produced roughly $41 billion in insured losses in 2005. Hurricane Ian in 2022 ran to around $50 billion. Florida's homeowners market has seen carriers become insolvent or simply stop writing, because when losses correlate perfectly, the law of large numbers stops being a law. The third is interest rates, and it is the one most people miss entirely. Float is only worth having if it earns. In the near-zero rate years following 2008 and again in 2020, the investment income on that float compressed toward nothing, which meant insurers suddenly had to make actual money on underwriting, a thing much of the industry had quietly forgotten how to do. Rate discipline tightened, prices rose, and coverage got harder to buy. Nothing about the risk of driving had changed. The yield on a 2-year treasury had. The fourth is regulatory rate suppression. Insurers cannot set prices freely. Rate changes must be filed with and approved by state insurance departments, and those departments answer to voters who are also policyholders. When the actuarially indicated rate rises faster than what regulators will approve, insurers do not raise prices, they withdraw. That is the mechanism behind carriers exiting California and Florida homeowners lines. Coverage did not become unaffordable, it became unavailable, which is a different and worse problem. The fifth is adverse selection sharpened by data. The model requires the insurer to know more about the risk pool than any individual in it. When customers know more about themselves than the pricing model does, the good risks leave for cheaper coverage, and the bad ones stay, and the pool rots from the inside. This is why telematics exists, why Progressive Snapshot and every competitor's version of it want to watch how hard a driver brakes. It is not a customer service feature. It is an arms race to keep the insurer's information advantage from eroding. Every one of those 5 attacks the same thing: the gap between the money coming in and the money going out. Widen it, and the business prints. Close it, and the business is a slow-motion charity with a marketing budget. So here is the whole thing in one line. Insurance does not remove risk from the world. It divides risk, prices it, moves it somewhere better able to absorb it, and rents the money in transit. That last clause is the business. Everything else is the delivery system. When the premium leaves an account, the transaction is not a purchase of protection for the coming year. It is an unsecured, interest-free loan to a financial institution, repayable only on the occurrence of an event neither party wants, on a timeline the institution controls. The protection is real, the claim will be paid, and the arrangement is legitimate. But it is a lending transaction wearing the costume of a retail purchase, and the lender is the one holding the policy. So read the policy for what it actually is. Not a promise, but a term sheet. And read the calendar next to it, because the length of time between the day the money leaves and the day it might come back is not a detail of insurance. It is the